Hello, hello, hello. This is Yaro, and welcome to an EJ Podcast solo episode. I'm here today to take you back through all the different investments that I've made over the years with predominantly the money that's been generated from my online businesses. So, this is not really about my online businesses as much as it is about the money I've made from those businesses and what I've then done with it to grow my capital, to ensure my financial future, and just have fun. Really, some of it is fun. It is fun to make investments. So I've done a range of things. I've actually got 7 dot points that I want to go through with you in this audio. This is part of my solo series. So if you are concerned about the EJ podcast no longer doing entrepreneur interviews, don't worry, I still do entrepreneur interviews, and in fact you would have seen many over the last few months. I've actually been increasing the number I've been publishing, but I've also been doing these solo episodes, and I got some great feedback on the affiliate marketing one I did a few episodes ago, and I also did a couple of other solo episodes before that. So I hope you enjoyed them. I think this is a great topic. I'm going to dive straight in. Bear in mind, this is not necessarily something you should consider only if you have money to invest. That's like a huge amount of money. When I started investing, as you're going to hear, I really went in with only a couple of $1,000s. I really think you can start investing as soon as you have any kind of capital, even if it's a few $100s, you have opportunities to grow that. And as I have learned over the last few years, you really want to grow your capital base and make sure your money is working for you. And I think that's a great place to start this episode, which is my philosophy and my strategy behind investing and where that came from. So I think one of the best places I can refer you to as an origin point for my own assumptions, my own beliefs about investing is a very simple book called The Richest Man in Babylon. It's a great book. It's a short book. It's one of those books that's a fable. So it's a story that also passes on education. My favorite types of books are books that do that. If you know me well, you know The Alchemist is one of my all-time favorite books, and that tells a great story, another fable by Paulo Coelho, about enjoying the journey, not just the destination. And even some of the books I read about business, you probably know Rich Dad, Poor Dad. That's a story as well with, this young man telling the story about his two fathers, the academic, traditional career path father versus the business owner father. And those stories help you to learn and cement the ideas. So for me, the place where I really got a great starting point for investment knowledge is this book called The Richest Man in Babylon. And I strongly recommend you go grab it. Listen to it on audio if you can find it, or just read the print version. It's not too long, as I said. And just to give you a summary, it basically takes you back to Babylonian times and explains the story of, yet again, a young man trying to create wealth and some of the experiences he goes through, and of course the mentoring he gets from other successful, basically entrepreneurs and investors. And I'm not going to go over the whole book for you because I don't want to spoil it for you, but I'm going to tell you the main takeaway I took, which is a pretty obvious lesson. The book makes it very clear. And the idea is to save 10% of your money for your investments all the time. And that's 10% of your income. The way the book phrases it always put away 10% of your money for you and you in your future, basically. The other kind of rule that it puts out there is the rule that you need to grow your income at least 10% a year as well. And then it shows you the power of compounding. Now, I think most people who went through traditional schooling system will probably know about compounding because you learn about it in your math class. I didn't pay much attention to math. I hated that subject throughout my entire schooling and university years. But at least with compounding, I understood the principle. No pun intended there with these words I'm choosing. But the basic idea is seeing the power of compound interest over time. And that's why The Richest Man in Babylon tells you to try and get at least a 10% gain on your money every single year. And over time, you'll see how incredible your growth will be. If you want to see that, just go on the internet, look for an investment calculator, just put in 10% interest and put in whatever amount of money you want to start with, and look at what that money is over 10 years, over 20 years, over 30 years. It really starts to get incredibly massive when you start looking at 20, 30 years, especially those last few years, because you're dealing with such a large capital base. It jumps. So if you take these two basic ideas, save 10% of the money you make for investing, and make sure that 10% goes into something where it grows 10%, where your money works for you. And what I loved about The Richest Man in Babylon is it talked about this idea of your money working for you without you doing anything. To me, that tied in so well with the same philosophy that I was looking to build a business around. I wanted a business that would work without me needing to be there to do much. Ideally, only the activities I wanted to do to keep that business going, possibly no activities at all. One of my businesses was designed to function entirely without me. My current business is designed to function mostly without me, but give me the opportunity to do the jobs I like create this audio for you, or write a blog post, or do interviews, or do teaching. But the basic idea was create machines that run for you, and the same principle applied with investing. Put your money into things that grow without you needing to do things. So I love that principle, and I was looking for types of income sources, in particular investment sources, that would do that. Now that's difficult when you're getting started. I really feel, when I look back at my younger days, how challenging that was, especially because I felt with a lack of capital, with no savings to begin with, it really felt like a slow process. If you're working a job, I had a part-time job, and even during the probably the first 5, 6, 7 years of running my business, there wasn't a lot of saving going on. Most of my money was just going into keeping me afloat, really, because I was only making enough money to sort of cover my bills, and also, pay for rent, those sorts of things. And what was left over, I certainly did follow the 10% rule, but we're talking saving 10% of my $15,000 a year income when I had a part-time job is only $1,500, and that's not a lot of money, depending where in the world you are. Certainly where I was growing up in Australia, it wasn't a lot of money, so I felt a little restricted on what I could do with the amount of money I had. So my first goal with investing was actually to generate more cash, which is why I spent more time growing my business during the first, 10, 15 years of my entrepreneurial/adult life than I did really focusing on investing. However, I did, and I do have a story to share with you about my first ever attempt at investing, because I was actually given a loan, or I shouldn't say a loan, I was actually given some money because I asked from my father. So let's do this in order. This is number one of my investment stories to share with you. This is probably the one I recommend you don't copy, but I want to share it with you because it is part of my story. So this happened during the dot-com boom, the very first one. I would guess it's around 1999. I can't give you the exact time, but I know that's when the dot-com boom was really pumping. I was 18, 19 when this was happening in 1999, and I had no money to my name beyond a little bit of savings. I might have had $1,000 or $2,000, if that. I wasn't really looking to spend that money. That was my emergency fund, that was my saving up for travel fund, and that was my pay for movies, kind of whatever fund. So I didn't have money to put into anything, but the dot-com boom was going on around me, and I'm just hearing story after story of people getting so much money by investing in tech stocks. So I wanted to get on board with that, and I went to my father and said, can I borrow or get some money to put into the stock market, because there's so much money being made right now. So I got caught up in the frenzy. Now, my father, is not a stock investor. He's done a little bit on the side, but it's never been something he focused on. So, he wasn't in a position to, really say yes or no regarding doing that as a smart move or not a smart move. He was just there to encourage me to, I guess, take some risks. And he gave me, I can't remember the exact amount. It was somewhere between 3,000 and 5,000 Australian dollars, which was a huge amount of money for me, and not an insignificant amount of money for my dad either. So he didn't give it to me lightly, but he did give me that as money to play with, I guess is the best way to put it. And that's what I did. So I went in, invested in, I think maybe two stocks. Both of them were tech stocks, companies now that don't even exist anymore. I remember one of them was an online shopping mall, some sort of attempt at an online shopping mall. So I put my money in, and I did actually have a good result with one of my investments. I think I put $2,000 in, and it actually grew to $3,000. So I actually made 50% gain on that money, but then I lost it pretty much very quickly. It was one of those, wild times. So I saw the money rise, and then I saw the money disappear within the space of probably a year, primarily because that dot-com bubble burst, as we all know, and I lost my money. But I also lost my money for another crazy reason. It was the millennium bug when the year 2000 crossover happened. So for those of you who weren't alive, which is crazy to think about, but there may be some listeners who were not alive when the millennium crossover happened from 1999 to 2000, there was this concern that computers were not prepared to switch their software over from 1999 to 2000, and it might cause a lot of crashes. So here I was, New Year's Eve was about to happen for 1999, and I had some money in the stock market. My stockbroker, who I was actually buying stocks through, it wasn't electronically. I was using a broker, old school style. He was actually the one kind of pushing me. I kind of half blame him for me getting involved because he hyped it up for me and got me excited about investing in the stock market. So he actually went off to Malaysia and was at a big airport party, some sort of rave at an airport during the Millennium crossover. So he wasn't there to hold my hand regarding this Millennium bug business. And I'll be honest, I freaked out, and I actually sold all my stocks before the year 2000 crossover because I was afraid that everything would crash. And because you can't trade over that New Year's Day period, I decided to get out of the market. I made a little bit of money because I got out at a good time. And then the Millennium crossover happened, and nothing bad happened. Stocks bumped up. I would have made way more money. I'm looking at the data. I would have gone from about 5,000 to 20,000 if I stayed in the market. So there's one lesson. Don't let irrational fear take out your money. And unfortunately, I then put my money back into the market after missing out on this big gain, and then the dot-com burst happened after that. So to cut a long story short, regarding this first experiment with investing in the stock market, I basically lost almost all that money, and the companies I invested in no longer exist. It was crazy times. One of them, the online shopping mall, it eventually merged with a mining company in Australia, which is a weird thing, the way mining companies were getting bought out or combining with tech companies because they wanted to diversify. I'm not sure. I didn't understand it. Long story short, lost all my money. Really learned a lesson from there, and it was a long time before I did any more investing because I had to build up my own capital. I'd lost my dad's money. I didn't have a lot of cash flow myself, so I was 18, 19, and that was it. So I think for the next probably 5 or 6 or 7 years, I was all in on my business, and I kept saving money from what I could, and I stuck to that 10% rule. In fact, I really believe in, maybe I'm good at this because I'm a bit of a minimalist, but I believe in saving more than 10%. Mostly because I just don't have a lot of expenses in my life, and I'm not, trying to always buy the latest car, keeping up with the Joneses, as the phrase goes. So having that somewhat minimalist lifestyle, I was able to save more than 10% because I just, I don't have any kids, didn't have any kids then. I was living with my parents partially, my mom at one point. So there weren't a lot of costs involved. So I was able to put away a lot of my business revenue into my savings account, but we're not talking a huge amount of money. I think I remember I might save 5 to 10,000 a year at best, and I think after 5 years I might have had $35,000 saved up, but that was it. Now, the good thing about having that $35,000 saved up was it did allow me to make my next investment. So I really don't call this an investment so much as I was doing it for purely an investment. I was actually doing it because I needed a place to live. And what I'm talking about is buying my first property. So in my case, growing up, property investment was what I saw as how people gained wealth. My mother had bought a couple of properties. I'd seen her do this. I knew she was doing that as her plan for retirement. She didn't have she kept changing jobs throughout her life, so she wasn't exactly building up an investment superannuation, as it's called in Australia, from her jobs. Although she had a little one, what she was planning on doing is living off these properties. That was the plan. Plus, I'd seen other people do this. I remember reading there was a publication in Australia called the Business Review Weekly Top 500 or Top 100 Wealthiest Australians, and it reported that about 80% of the people's wealth was made from property. So I saw property as a clear vehicle for wealth, and I wanted to get my own place to live in. So it made sense to buy a place, which is what I did. So I bought a 3-bedroom townhouse in Brisbane, Australia. And if you go into my blog archives at entrepreneurs-journey.com, you can see around the year 2007, I published photographs of my car. I bought a brand new car as well as that townhouse. And that came about after doing two things. I launched my first course, and I sold my editing company. Two stories I have talked about many, many times on my blog and in podcasts before, so I won't go over them now. But I was flush with a bit of extra cash. So I had my own savings of 35 grand-ish. Plus I suddenly sold this business, so I got 100 grand coming in, US dollars, which is a huge influx of cash. And I launched this course, so suddenly I was making an extra 10,000 a month in fairly consistent income. At least I was hoping it would be consistent for the next, probably 12 months as my members kept paying. So I was in a position to do some better investing, and the first thing I did was buy this townhouse. It cost me 335,000 Australian dollars. I remember it very well, and it was at the tail end of a bit of a property boom in Brisbane. So I actually gained about 10% in value increase over the next year. I remember looking at the data before Brisbane's market went flat. So it turned out to be, as I say this to you now, a reasonable investment, because you'll hear later on in my story I did sell that property. But at the time, it wasn't really a great investment because there was about 5 or 6 years of flat growth. But it gave me a place to live, so that's always a good thing, putting money into a mortgage, a home loan instead of rent. And I did get a bit of capital gain, that 10% boost. Plus, it was better to do that than put my money into other things. Like, I bought a new car. Probably was a mistake in terms of investment. Wasn't too expensive. It was a $26,000 car, but I could have bought a second-hand car instead. That might have been smarter. So that was my first property investment. Now, around this time as well, I started investing in virtual property. So this is my third investment experience. So first was the dot-com boom with stocks. Second was my own first property. Third was buying blogs and websites. Now, this for me was a real strategy for increasing my income and increasing my capital. So I was well and truly aware of this growing opportunity to invest in virtual real estate. And it was still something fairly new to do today, really new back then. Flippa, as we know today, flippa.com, it's a website that lists sites for sale. There's many others, but it's the most well-known one. It was just starting to boom, and I really took it seriously. So I bought a blog, and I then bought another set of forum sites. I also invested in another blog later on that didn't do too well. And again, I'm not going to go through the specifics of what happened with my buying strategy, because there's a complete training program on my blog on how to buy and sell websites, where I tell this story and several stories. I have an ebook, a course on this. There's a video presentation. There's a bonus in there. Lots of training. So head to my blog if you want to know about investing in blogs and websites. But I will tell you, from an investment standpoint, it treated me really well. This was probably, for me, the first time where I felt like I made a really smart investment, and it was cutting edge. Not many people were doing this. And it felt, I won't say like it was easy money, but it was certainly, it felt easier than any other investment I had done prior, because I was buying virtual property. So I remember collectively I spent, I think, about 20,000 Australian dollars overall to buy my entire portfolio. And the end of that investment period, at one point I had 2,000 cash flow coming in. $2,000 every month was coming in collectively from the advertising income from this portfolio. And then when I sold it, if I think back correctly, I think I did more than double my money. I'm just going to do the math. I know I sold one set for 25,000, another set for 25. Yeah, I did way more. I think I did about probably around $55,000 in return. And this happened over a couple of years after buying the sites. So I probably made around about collectively $100,000 on a $20,000 investment over a period of about three years. And that doesn't even include the 100,000 I made from selling my editing company as well. So that was another burst of capital that went into buying the house and the car. So I consider that a great strategy. I still think it's a great strategy today. It's more difficult today. You've got more competition. It's harder to find the good deals, but they're there. And if you do the research, if you know how to practice your due diligence, you can make good money buying and selling websites, or just buying and holding them as a cash flow source. People back when I was doing it were buying niche websites, collecting them up into a portfolio, and selling them for millions of dollars. Ed Dale sold, I think it was 26 niche websites for $5 million. They were making, I think they were making about $50,000 a month in revenue for him from advertising, and he made $5 million in the sales. So it was a huge deal for him. So that was my initial kind of earlier days experience. Now, as we move forward, my capital is really starting to accumulate at this point. So, one thing I'm not going over here is my business is growing. I'm releasing more products. I'm starting to have years where I'm making 200,000 a year, and then 500,000 a year, and I've got a great profit margin, about 70% to 80% profit margin. So if you factor in 30% of my money going to tax as well, if I made $500,000 in 1 year, I would have kept maybe 350 to maybe 400, maybe a little bit roundabout somewhere like that in terms of net profit. And then you got to factor in 30% of that going to the Australian government. So I probably kept around $250,000 of actual profit into my bank account for me to make use of. So that's when I started doing other more investments. So I ended up buying another house, my dream apartment in Brisbane, and I turned my first townhouse into a rental property. So that became an income source. And I actually ended up buying another property. At one point I had 3 properties in Brisbane, 2 investment apartments in the apartment I lived in. And that was great, good time. But I had a lot of debt. There was mortgages there, and I poured all the money that I'd made in my business into my own apartment, which was debt-free. But the other 2 investments had debt on them, and that was a good property investment experience. I won't say it changed my life, but it felt safe and smart in what everyone else was doing. So going forward, the next point I want to talk about is a little bit different. This is an opportunity that came to me, and this is something that could happen to you as well as you start getting more involved in networking and meeting people doing similar things to you, or just being involved with other online entrepreneurs. So I had a friend who you might know. I've interviewed him a couple of times on my blog, called Alborz Fala. And shortly after I started my blog, he actually started his blog. So around about the year 2000, I think around 2006, because I know that, or maybe 2005, because they just had their 11th year birthday as I record this. So he started a car blog called caradvice.com.au. Now, I was living in Brisbane, he was living in Brisbane. It started off as a small blog, but it ramped up pretty quickly. And then he got investors and a partner, and they started getting employees, and then they got a CEO, and it became a huge company. Today, it's a 20 to 30, I think it's about $30 million valuation last time I checked. They've got like 30 plus staff. And what happened, because I was friends with Alborz and I was around him so much, I got to hear the story behind the scenes firsthand. Like every time we meet up for coffee, I'd be like, what happened with Car Advice this week or this month, if I hadn't seen him in a while. And it was always good news, so almost always good news, except for the 2008 financial crisis, where they had a lot of income dry up from advertisers no longer spending money. That was a scary period, but every other time I spoke to him, the company was growing really quickly. And there were a couple of times where I had an opportunity to invest in the business because they were looking for investors, seed investors, to help the business grow. And I know I said no the first 2 times, mostly because I just didn't have the cash flow. I'd rather put the money into my mortgages. That was my mindset. So I was paying down my mortgages. But by the time the 3rd time, he said there's an opportunity to, again, buy some investments, some stock into this startup. I was like, you know what, I've got some spare cash. I'm going to do it. So this was like 2008 or 9, I think, by now, maybe even later than that, might have been 2010. So I decided to invest in his company. I didn't buy much. I think my at the time, my percentage ownership of the company was 0.78%, so less than 1% of the company. But you know, it was obviously about growth over time. We all know that, you know, 0.78% of a company that sells for 100 million is actually several million dollars, so it's not a bad thing. But the point is, well, not quite several million dollars. It's a good return on investment anyway. It's almost $1 million. Anyway, I put some money in, and it's still in there. So I really can't tell you how well it's going to do. I do know the company has doubled in value, but it's also brought on more owners since then. And actually, the company has been sort of sold. Half of it's been sold, and it has been sold, but there's an agreement to buy the second half. So the current new owners they have an option basically to buy the second half after 3 years, or not even an option. I think they have to, but a lot of it's based on performance on how much it sells for. So I decided not to sell when the new owner bought. In fact, that was last year, under the idea that in 3 years' time, it should be worth more, and therefore I'll get a better return. And I didn't need the money. I didn't have anything better to do with the money personally at that time. So I kept my money in there. So I don't know what that's going to return on investment. I feel like it's already doubled in value. We're talking 5 years now, 6 years since I did the investment. So it's not necessarily a hugely good return on investment, but it could be, and it could be even better depending on how, you know, the growth is. And that's exciting. I like the idea of sort of putting myself down as a seed investor in potentially a fairly well-known tech company. And it is a well-known tech company now. It's got a lot of coverage in Australia anyway, as a large independent car website. So that was fun. In fact, I've done a few more, I wouldn't call them seed investments, but pre-IPO investments in companies as well, which I'll talk about in a moment. So, okay, just to summarize, in case you have lost all the different investments, I had my failed .com bubble investments, did not too bad, buying and selling blogs and websites, and putting my money from those kind of things into my first property, and then a couple of other investment properties. And then most recently, my investment in a tech startup, Car Advice, a tech blog, basically, again, another blog. So I've very much been in the world of blogging and investing my money there. Now we're heading into much more recent times now. So this is literally the last 3 years for me. I had way more capital. So, you know, I saved a lot of my business income. I also had, unfortunately, you know, deaths in the family. So my grandmother and mother passed away, so I got a bit of inheritance from that as well. So I've had more capital around. I want to be careful. I didn't want to throw away my family money. Obviously, I wanted to, you know, keep that for my own potential future retirement type situations. I wanted that to be protected money, but I also had business cash that I want to potentially do more fun things with, was the best way to put it. And for me, fun things were looking for opportunities to invest in companies that were in seed rounds, startups, essentially tech startups. And a few opportunities started to come up in the online space to do things. And there's two websites in particular that I came across over the last few years. One is called Angel List, which you might know of. It's become very well known in the startup world. Another one's called Equity Zen. We'll put the links for all of the sites I'm talking about with the show notes for this episode. And this is the 4th Yaro solo episode. So if you are listening to this and you can't find the page that goes along with this podcast, maybe you've downloaded it on your phone, it'll be available through ejpodcast.com/4, just the number 4. ejpodcast.com will take you to my podcast homepage as well. Yes, so Equity Zen is basically a place that brings together people who want to invest in pre-IPO companies and current shareholders who are usually the employees of these companies who'd like to get a bit of cash flow for their equity in these companies before IPO. So a lot of companies, it's difficult for employees to get their equity out of a company until it floats. So as a way for them to free up cash, you know, maybe to buy a house, whatever they need the money for, they can go to a service like Equity Zen and say, I'd like to sell some of my shares in this company I work for. And then people like myself can join as an investor, and we get to buy basically a share of a purchase packet of shares that are being offered in a company. So I bought into Palantir, which you might know is a big company that one of the biggest unicorns right now, actually, a tech company. Peter Thiel is the CEO, I believe, as I record this, who's well known from PayPal, being one of the founders of PayPal. It's a sort of a secret spy company. It does a lot of research using big data for the government and for other companies to give them really unique insight into data. Not a lot is known about them. They're quite secretive. To be honest, I wish I didn't invest in them now, looking back in hindsight. Not from a financial point of view, but I've actually kind of started to be a little bit more discerning with where I put my money, and I don't want to be supporting a company that necessarily supports maybe military type operations. I don't even know, but I believe that could be the sort of thing it's being used for. So I'd rather invest in companies that I actually like and know what they do more so, and I have done that in more recent years, as I've invested in things like Facebook and Amazon. I know what they do, and I use those services myself. But I have invested in Palantir, and I've looked to do another few investments. I tried to get into Stripe because I really, really love Stripe, and I use it, and they were having a round in EquityZen, but the Stripe round collapsed, unfortunately, so I never got into that because it never happened. So far, only Palantir has been my investment through EquityZen, and that could turn into something great if Palantir floats and they have a huge valuation. I can exit at that point. In fact, it's kind of a new area. I don't even know how the exit process works yet. EquityZen, I'm not even sure if they had their first exit yet. It's such a new service. AngelList, kind of similar to EquityZen, but a little bit more of a social network. And it's really become a great service for people looking for jobs at startups. It's now a huge sort of recruitment website where startups can find people to hire, and people looking for work at startups can join their startup teams. But it's also a place where people like myself can invest in companies. And I'm not sure how I came across AngelList, but I know Tim Ferriss has been a big influence there because he was one of the people I followed at AngelList and seeing what he invested in. And I actually joined his syndicate. With AngelList, you can join syndicates, which means you go in and invest with the investments the leader of the syndicate does. So Tim is a leader of a syndicate there. I back his syndicate every time he makes investment in a startup there. I put an investment in too. And it's not a lot of money. You can start with as little as, I think, 500 or maybe 5,000. I haven't checked their recent numbers. Me personally, I started with a $5,000 investment in a little fund that they floated at one stage. AngelList had they called it like a health fund, and it was 10 not tech companies, 10 health companies, very much tech related. Some of them were tech companies, but they're all doing things with health, and I like that. It was the first ever fund by AngelList. I put 5,000 in, which is the minimum you could get in with that. And basically my $5,000 was a $500 investment in all those 10 companies. That was a number of years ago, so I've been able to look at my investment. And it's really interesting because you can see, one of the companies folded, one of the companies actually got bought out by Google, and I had a double my money return. Unfortunately, double my money was, $500 turning into $1,000, so it wasn't like, whoa, I'm a millionaire, but it was pretty cool to see an exit happen and, see the money come back. I think the other 6 to 8 companies, they're still going, some have merged with other companies. And then the idea is that at some point they'll either IPO or get bought out, and that's when you get some kind of potential financial return, just like EquityZen. So I keep watching EquityZen and AngelList, but so far they've been very, very minor investment strategies for me. I think, as I said, EquityZen, I put about $20,000 into Palantir. AngelList, I had like that $5,000 investment, and then there was another I think another small investment I did of $5,000 into a Tim Ferriss recommended startup, and that's it. So yeah, we're talking $30,000 there, and one day I might get a pleasant surprise from one of those two sites. But I do keep my eye on them still, because if something like Stripe comes up again, I'd love to get involved with that kind of company. I also like AngelList because I do potentially want to invest in even earlier stage startups. That's why I lived in San Francisco for 3 months. I was just seeing, what the scene was like there, and I may one day return there, or even just do it virtually from a distance, because I love I love tech and I love startups, and it'd be great to be involved with a startup that I really like what they're doing and to put some of my money towards it. And from a financial standpoint, I've heard some incredible stories. I know Tim Ferriss has had multi-million dollar returns from a $20,000 investment in an early round in a company, a seed round. And I know there's a number of other people, they'll tell you that's how they make their big money. I was reading a book about Uber and Airbnb, and it was incredible the returns that a $20,000 to $50,000 investment can deliver when a company has an Uber-like result, which is not common. We should be very clear about that. That's kind of like a bit of a getting lucky situation. So, but it's still a fun thing to do, to be involved in the tech world. And we're heading into the last 2 points here for you to wrap up this investment episode of the EJ podcast. So you probably know this if you're at all involved with my world and certainly the personal development space. Tony Robbins released a book. In fact, he's got two out now, but he released a book called Money Master the Game, which was a fairly thick book where he spent a lot of time researching and talking to some of the most successful financial people on the planet to demystify the world of investing for the average person, in particular pointing out how ridiculous it is that people invest in mutual funds in the United States, because mutual funds just underperform compared to really simple things like just investing in an index fund in the stock market. So I went through Tony's book, and it was eye-opening, a little bit tailored to Americans, and coming from Australia and Canada, for me, it wasn't 100% relevant, but it was mostly relevant, and I learned a lot. The biggest lesson for me was you will get, if you want a long-term stable return on investment, put your money in an index. You're much more likely to do better there and get your 10% aggregate. Like this book, written today versus The Richest Man in Babylon, which is a really old book, they both presented the same idea. 10% of your money compounding. If you can put 10% away and get 10% or more a year, you will become a wealthy person. You will become a millionaire given enough time. So Tony pointed that out, and Tony's advisors, people like Warren Buffett, they pointed out that the safest, simplest way is not to find a financial advisor in a mutual funds type situation, because they're going to siphon away a lot of your money in fees, and they're incentivized to trade, which means you lose more in fees. And it makes sense for them because they get money from doing that, but you don't. So I pulled, in fact, my money was with a similar type thing in Canada, my inheritance money from my grandmother. And I pulled that money out of that situation, especially because of the advice Tony's book offered. I was like, why am I paying these fees and I have no idea what my money is put into? I get these reports, but I don't really know what's going on. So I pulled my money out, and I went looking for the sort of thing that Tony Robbins and all of his wealthy people advised, which was some kind of index-based portfolio. Not just one index fund, but a range of index fund in a portfolio environment, in particular one with low fees. So I tried some of the resources Tony's book offered, but I didn't really get great options for Canada, which is where my money is now, my business is now. But I did find a service that's basically got the same kind of ethos, which is called Wealth Simple. So I have a huge chunk of my, what I would call long-term financial savings, my retirement type money, in Wealth Simple. Now, Wealth Simple is a service, I believe it's only for Canadians right now, but no doubt it will expand, is basically a low fee investment portfolio that is very much based on that kind of ethos of putting money into index type funds, not doing a lot of trading, and just keeping things diversified and balanced for you. So they do rebalance your fund according to the sort of principles that Tony's books talk about. But it's all hands off, and it's all low fee, and it's designed for you to have an attitude of keeping your money in it long term. It's not a high volume trading account where you should be putting money in and out. The great thing about it, it is liquid. I can pull money out at any point in time. So if I need to use that money for a deposit on a house or some sort of family emergency, it's available to me. But ultimately, it's meant to stay in there, and you're meant to ride the waves. So keep your money in whether things are good or bad, because on aggregate, over time, you're going to get that 10% plus growth. And they have a great graph in it, attempts to sort of extrapolate what you can expect in long-term income from it. And my goal is to just keep putting my, kind of a regular amount of money. I've got it set up to put about $5,000 a month into that over time. So it just slowly grows, gets that 10% or greater growth every year, and turn into just a really stable, reliable income source, kind of like my safety net is what I call it. Now that contrasts really well with the other thing I've been doing more recently, which is investing in stocks and cryptocurrencies. So let me give you a bit of background with that. This is my fun trading. This is really more speculative, more risky, but a lot more fun and something I look at on a daily basis. Wealthsimple, I might check in once a month, see how it's doing. It's done pretty well, in fact, because it's been an up year this year, but I know it could be a down year. As soon as the markets crash, it could go down, but overall it will just, have a good aggregate growth curve like an index fund should. eToro, craziness. So, well, the story behind eToro was I, about 3 years ago, wanted to invest in Facebook. So for me, back in the post.com bubble bursting, so in the early 2000s, after everything crashed, a few companies rose as really solid businesses, namely Amazon.com and eBay.com, and then Google.com. And if you know the stats, if you invested in Amazon way back then, $1,000, it would be worth like $600,000 today. So it's an incredible return. In particular, I saw the rise of Google because I was benefiting from Google. My blog continues, and certainly was in the early days, driven by Google traffic. And when I saw them release their Google AdWords platform, I was like, this is a money-making machine. This company is going to explode. Unfortunately, as I explained to you earlier, I didn't have the capital to invest back then, or really the sense to invest back then in companies like Google. But today, and the last sort of 5 years, I have had the capital. And when I saw Facebook was releasing an ad platform, and then I started using it, and then suddenly everyone started using it, I thought, wow, this is kind of similar to when Google released their ad platform. I want to get into Facebook now. I've got capital, I've got timing, I've got market intelligence in the sense that I'm involved with this company. I'm seeing what they're doing. I'm seeing the greater marketplace. Let's get in and sort of see if I can ride the wave similar to Google's rise. So I went looking for a way to invest in Facebook, and I came across this service called eToro, which is an online trading platform that actually does something kind of unique. They allow you to copy other traders. It's their unique specialty is copy trading. So you can invest in other investors on the platform if you want to, or you can just invest directly in stocks or currencies. There's a few EFT type situations too, where you can invest in commodities. So I bought Facebook to begin with, and then a little bit of Amazon. Unfortunately, a little bit of Twitter. Twitter, I bought at a really bad time for Twitter. I lost like 60% of my money, but it wasn't a lot. I only put 5,000 into Twitter. And then I kind of sort of left it alone. I checked it maybe once a month, every 2 weeks. I didn't really play around with it much, but I did sort of keep an eye on it, especially to see how Facebook was growing, to see if I was, sort of proving my own point. And it has done well. It's still early days, but it's done pretty well. And then in the last sort of 6 months, this whole Bitcoin phenomenon has been really in my mind. Bitcoin's been around for longer than that, but I've seen it, I've known about it for a couple of years, but I started to really kind of pay attention to it, especially because just this year, after living in Toronto last year, I met a friend named Amir who started talking to me about blockchain and cryptocurrencies, which, in case you don't know, is kind of like the technology behind things. Blockchain is the technology behind Bitcoin, which is a currency that's completely deregulated. There's no sort of ownership of it. And there's a new one, and this is what Amir, my friend in Toronto, told me about, called Ethereum. So it's another cryptocurrency that was taking off really well. And in the case of fortuitous timing, at the start of 2017, eToro made Ethereum trading available. They already had Bitcoin, and I wasn't into Bitcoin yet, but they had Ethereum launch, and I decided, you know what, maybe Ethereum, based on what I'm learning about everything with Ethereum and everything with blockchain and cryptocurrencies, is potentially the next Bitcoin. So I'm going to jump in with some money, sort of as a buy and hold. I wouldn't call it a long term. We're not talking my retirement, but I'm happy to put it in there for 2 or 3 or 4 years. And if it goes on a similar ride as Bitcoin, I can make a lot of money. And that we're talking 10x my money, which is kind of like my strategy. I wouldn't call it a super sound strategy. My gamble is probably the better way to put it. But I did that, and I started investing more frequently too. I started buying other companies, Nintendo, and Also, Shopify, which you probably know of. It's it's a Canadian company. They're basically companies that I know about and did a bit more research, as well as the cryptocurrencies. And Ethereum's done really well. It is gambling, though. It's very speculative. And the money I put into eToro, I kind of see as the money I'm prepared to lose. So it's never been nearly as big as the money I put into Wealthsimple. So it's more about gambling, but it's done incredibly well. I'm actually more than double my money at the moment. I've turned about $50,000 into $150,000 in the space of about 6 months, thanks to primarily Ethereum, and it's still going up. I'm still holding it. The strategy is still the same. It could disappear overnight. It could go, could return to back where I bought it, not level and stay there for a long time. Who knows? But I'm certainly enjoying the ride, and I'm actually starting to learn a lot more about this world of stock trading. So that's been interesting to me. But as you can see, there's like the more solid Wealthsimple, long-term, low-fee, aggregate gains, 10% a year or better kind of richest man in Babylon strategy, versus these let's ride the wave of a cryptocurrency. And yeah, you can double your money in the space of 6 months, but you could also have your money in the space of 6 months too. So it's not a great, safe, long-term strategy. It's trying to play the market, and that's never the smart thing to do, as Tony Robbins' book taught me. So there's a mix there of fun investing, gambling, as you might call it, and then smarter, long-term, stable investing. I bought a place in Toronto, again, another property, which I actually ended up selling a year later as I decided to continue traveling. I didn't want to live in Toronto, and I made a bit of a profit from that. And I've sold off most of my property in Australia. I only have one apartment still there. So I pretty much got most of my money in either Wealthsimple or eToro, so stocks and long-term index funds, and one property in Australia, and then cash on hand, and also the last thing, which is my business. So I haven't really talked about this as an investment, but your business really is an investment. Obviously, it produces cash, and you can use that cash to reinvest in growth. And I've certainly been doing that in the last year or so, as I've been mostly reinvesting in hiring contractors to help me do more things with the business. And that has certainly helped and create a lot of freedom in my life, but also, helped to take away things that were taking my time and allowing me to do other things, but like creating new products quicker, things like that. So I have to end this with that last point, which I think is also the first point in a lot of ways, because before I did any of this investing in other websites or properties or seed investing in startups or Wealthsimple with index funds or more speculative stocks and currencies with eToro, none of that could have happened without me actually, first of all, growing and investing in my own business. So I want to kind of bookend all those other strategies with that idea that, if you can get 10% or more growth out of your company, that's probably the best place to put your time early on. Once you've got spare capital, by all means, put it into your first property to live in. I think that's a smart idea. Look at long-term, index type funds. I certainly think that advice I learned from Tony and all of his very wealthy, very smart guides. It makes a lot of sense to me as well. And if you want to have some fun with fund trading, set aside some money for that too. But really, investing in your own business, growing your stable cash flow, that's way more important. I really feel that that's enabled everything in my life. And I've seen people who, right now would love to have got in on the Ethereum ride, for example, but they don't have the funds available to invest. So, I really believe that opportunities to make money in things like tech startups or any kind of startup company as a seed investor, investing in, whatever latest craze might be happening, like a cryptocurrency is right now, or a tech company when it was Google, or before that when it was Amazon, or whatever other companies you're following, they only become options for you when you've got capital. And for me, capital comes from my own business, either from cash flow saved up, or when you sell a business, as I did with my editing company. I instantly, boom, $100,000 in my bank account, which allowed me to buy a property, which then allowed me to buy other things. So you need to think about that, and that's why it makes sense to grow your business. You're listening to me right now. This is an entrepreneurship podcast. That's the first place to invest. And then you can decide how to invest the excess, I guess is the best way to put it. I've always been a believer that you don't want to grow your business just for the sake of always growing your business. I think your business should be a tool to support your lifestyle, which is why my attitude has been, let's not put every single penny I make back into growth. Some people do that. Some people just want to go from, your first dollar online to your first $1,000 to your first 100,000, your first million, 2 million, 5 million, 10, 20, and just keep riding higher, reinvesting every penny back in. For me, it's all about balance, freedom, lifestyle. So taking money out of my company and putting into other things that are less labor intensive, and not investing every single penny into things like, full-time employees or expensive development, whatever other things I could do. I'd rather have the kind of the balance and combination I have now. Okay, I'm going to call that the end of this podcast. I hope there's some nuggets of wisdom. If anything else, I hope it was just interesting to hear a bit of the background of how I've spent money, how I invested money over the years. For me, the biggest tip to take away to share with you from this is all the way back at the start. Read The Richest Man in Babylon and follow that 10% advice. Save 10% of your money and make sure it goes out there and works for you to make 10% a year in growth at least. That is a very sound strategy. It makes so much sense. Go look at compound interest if you want to see how much sense it makes or how much dollars it makes. And I wish you well in your own investing. Once again, if you want to get all the show notes, all the links to go with this episode of the EJ Podcast, you can go to ejpodcast.com/4. That's 4. And that will take you to this episode. Or you can just Google my name, Yaro, Y-A-R-O, and you'll find the Entrepreneur's Journey blog. And just click the podcast link and you'll find all my previous episodes. There's my previous solo episodes and over 150 plus interviews with online entrepreneurs there as well. Thanks again for listening to the Entrepreneur's Journey podcast. I'll talk to you again on the next episode. My name is Yaro. Bye-bye.